Hey there, welcome to the show today. I was all sort of mentally prepared to talk about this raging follow through to the upside, but the market had a different opinion leading into the close, with weakness evolving into the afternoon, finishing right about where we ended the day yesterday. So instead of being a follow through to the upside, we're left to question, is this the end of a bull market recovery rally within a bear market phase? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's show. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the final bar to break down the day's price action, to analyze things from a technical perspective, but also, most importantly, connect it to the long term. And now more than ever, when we have increased volatility, we have a lot of uncertainty, no better time to pay attention to the long-term trends and understand how this day, this week, even this hour, this minute fits into the big picture trends. As I mentioned in the introduction, today is sort of, again, I feel like every day is sort of a little capsule expressing what the overall market feels like. And today we had a nice move up out of the open. It felt like the follow through we talked about looking for yesterday, but I don't know if we could say that's the case after the close, with S&P actually closing in the red. So we'll have to look at what that means. And my guest today, Harry Boxer, is hopefully going to help us looking at a little short-term read on the S&P and the Nasdaq. Now, coming up, we have a lot of guests like Harry to help us make sense of things. So coming up on this show, we have Jesse Felder tomorrow. On Thursday, we have John Kosar from Asbury Research. Then we'll take a holiday on Friday for the market holiday. We'll see you back next Monday for our show. But two other things I wanted to point out. Earlier today, we premiered our latest special event. That was me doing 7 bear market mistakes and how to avoid them. If you missed that, no problem. We'll be replaying it on StockCharts TV. You can also go to our YouTube channel and see that special along with all the other great shows and also the special events we've been doing recently. Next Monday, we'll do our next episode of Behind the Charts. That features Rick Bensignor. Rick runs In the Know Trader and also hosts a show of the same name on StockCharts TV. Someone I've known for a number of years. Had a great time talking about his background, how he approaches the markets working with institutional investors. Let's get to our market recap. Again, this day and this market continues to obfuscate the overall market sentiment. I feel like just when you feel that there's a sense of optimism, we get a negative move into today's close, somehow managing to pull a defeat out of the jaws of victory today. Overall, the S&P had gotten above 2740, closed back in a position of weakness to get negative for the day, so sort of round tripped it and went below the open. Mid caps and small caps a little bit better, so they were higher than the S&P, but overall, again, certainly getting a negative feel going into the close. The VIX is now back up a little bit to 46, just above 46, but overall still fairly elevated. Look at the chart of the S&P 500, and then we'll get into some of the many other things that we're gonna unpack here. So, as we talked about yesterday, we sort of focused on this, the previous high. We looked at a lot of stocks that had established an increase and then pulled back and now established a higher low from the third week in March. Now the first week in April, we get a higher low and now eclipsing that previous swing high. And yesterday we closed above it. And the comment was, if we can get a follow through day today, if we can close further to the upside, suggesting that there's upside momentum to be had, could be kind of a positive sign. We've also talked about this range, sort of this 2,700 to 2,750 range, and this is based on a Fibonacci retracement going back from the 2018 to 2020 rally, right about at 2,750. So we actually ticked that today. We traded just above it and then closed back in a position of weakness. So if we're looking for a follow-through day, I don't think we got it today. It was more of a digestion of the previous uptrend. Could indicate a short-term weakness going into the rest of the week. That remains to be seen. But I think overall, all this does for me is confirm the significance of the supply area, that resistance zone that we're right in the middle of. And again, all else being equal, if I see a bear market rally, I'd sort of eyeball this area as where you might expect a short-term top. I think what might be what we'll be seeing. We'll have to see what the market does, obviously, from here on out, but sort of the short-term read. Now let's look at some of the sector, stock, and theme movements that we can articulate here. So it was materials and energy, number one and number two. Energy had been leading a lot more earlier and sort of tapered off a bit. So materials up 2.6%, energy up 2%. And again, this is with the S&P essentially flat for the day, followed by consumer discretionary up 1.5%. On the bottom, you had utilities, consumer staples. The real concerning one, though, is technology. So tech has been an outperformer in bull market and bear market, or bull and bear phases for a year plus, right? Since the market bottom, tech has really been the place to be. Today, underperforming. So again, it's just the beginning of that potential move. But interesting to note that tech did not participate in today's improvement. Looking down at ETFs, you saw some of the commodity-oriented ones like a Brazil up the most, up over 4%, and then sort of a mixed bag of markets, including some Asian markets like Korea and Hong Kong. On the bottom of the list, and again, these ETFs for me are a great way of just visualizing the overall relative movements of global markets relative to the U.S. On the downside, you had others like Australia and Russia, so others that are also very much tied to commodity prices. Notable to see that the Chinese markets, for the most part, actually on the weaker side today. In terms of groups that did well and did poorly, we'll skip over tires. It's a pretty tiny group here, but up pretty big. Recreational services up over 10%. But then you get some interesting one. Mortgage finance names, full line insurance names, both in the financial sector. Transportation services up over 8%. Automobiles is the group with Tesla and others up 6%. And furnishing. So, it certainly wasn't a move to safety necessarily. It was sort of a fluctuation around things, because on the downside, you had things like the defense names, which were up pretty big yesterday, sort of reversing. Aerospace as well. Defense is actually interesting, putting in a bit of a bearish engulfing pattern. If you look at the little candle preview there on your screen, and also just, again, a mix of sectors represented on both places. So today, to me, felt more like indecision. By the time we ended the day, at the beginning, it felt like a follow-through day around midday Eastern time, but then by the close, again, more leaning toward distribution. As a reminder, it's always helpful to look at the Scooter rankings. This is where we break down the large cap universe as well as other universes, mid caps, small caps, and so forth. Looking at their relative ranks. So it's a percentile ranking based on the strengths of some of these charts. So we can see that there has been actually some movement in some of those top names, some of those, the coronavirus sort of recovery names, things like, Citrus is still up here, but some others that were in here, some of the staples names, Clorox and others maybe come to mind, no longer in here, but you do get sort of a mix of stocks represented. So make sure you take a look at some of those names. Interesting to see a gold stock, Newmont Mining, now in the top 10. That has not always been the case. Let's look at some of the macro sort of breadth charts and others to get a sense of where we're at with things. This is looking at the advanced decline lines for the S&P 500, as well as the mid caps index, as well as the small cap index. What we've talked about for a while is you'd really want to see some sort of upside move in these breadth indicators to get a sense that there was some appreciation, there was some accumulation happening at the stock level. And I think the question now is whether or not we've started to see that. Arguably, we've put in a bit of a higher low in some of these breadth readings. This is on the pullback into this week, and the rally we had yesterday. These are not updated for today's close just yet. We're sort of processing the data, but I think it's worth watching this chart to see if we get a bounce here and if we're able to eclipse that previous swing high. So stocks have been able to do that. A lot of individual stocks in the S&P obviously breaking above that swing high, but we're not seeing that with breadth. So the breadth is not confirming that short-term upside that we're seeing from some of the individual price charts. And again, for me, what I'd be looking for potential downside is if we start to break down and get a lower low, especially if we're able to break below the lows from that third week in March. That would really sort of confirm further potential downside. This is another chart we've looked at routinely, which is the percent of stocks in the S&P 500 above their 200-day moving average and above their 50-day moving average. You can see that these improved pretty dramatically in the last couple of days, and I think a lot of that came yesterday when you had a big up move. When we were looking at some of the individual charts, we're doing that segment, Shifting Stocks, yesterday, and I mentioned how many of them were starting to appreciate above their 200-day, especially not quite the 50-day, and that's sort of what the statistics have laid out. So we're now 14% of the S&P up through yesterday's close above their 200-day, 12% above their 50-day. That's coming up from 3 to 5% for both of those. So it's much greater. But again, what I would remind you from a breadth perspective is that still means 86% of the S&P is below their 200-day moving averages. So it's not a raging buy signal. It's more an alleviation of the downward momentum. But again, overall, the parallel that I'm drawing most specifically is back here, this 2008, 2009 period. We'll have to see if these continue to appreciate, if stocks are able to regain them, especially after a day like today, or if we rotate back down to sort of these, real steep bear market lows where the percent of stocks above their 200-day, remains below 10% for an extended period of time. So a potential really interesting turning point with some of those breadth measures. And I think with both of those last two charts, the advanced decliners with the percent of stocks above their 200-day, their 50-day, these are the charts that I'm looking at just to get a sense of what sort of participation we see in any short-term bear market rally. That's our market recap for today. Boy, it's so funny. I mentioned in previous shows in the last couple of weeks, you really want to have an exciting time as you're working from home. Pretend like you're recording a closing bell show and try to encapsulate the market activity right after these volatile days wrap up. It's exciting. I will tell you that. We need to move on to our next segment, though, folks, which is the the final bar mailbag. So what we love to do is answer your questions. I think having a good interaction with all of you makes this show really fulfilling for both of us, for all of us. And so I'd remind you, you can get questions to us a couple ways. The best way is via email. The final bar at StockCharts.com is the best way to get a hold of us. Also on Twitter, you can refer to our Twitter handle at FinalBarSCTV. We'll take a look at both of those and any questions you send in. We'll try to get to them as soon as we can. I'm going to try to keep it to a smaller number. I always have a great aggressive plan for answering mailbag questions, and I get through about half of the ones that I want to. So we're going to limit it to a couple today and see what we can do. Question number one, you mentioned narrative bias in a presentation recently. I thought an investment strategy would be built on a narrative. I think this is going to happen, so here's how I'm positioned, is sort of the thinking. Is narrative bias a good thing? And we've talked about this in different things. We may have actually addressed a question like this, and I just want to make it clear to everyone, because this is something that's come up a lot. We've talked about how narratives can evolve, and I think the thing to remember is that all the markets are not a simple mechanism; they are a complex mechanism, right? So it's not just two things that you're looking at. There are a lot of different moving parts. So here's an asset allocation chart showing oil, gold, bonds, the dollar, the S&P 500. So looking at the major asset classes over the last year. So it's very easy to make a simple comparison. Here's what I see in stocks. So this is what I think of gold. And a simple one is stocks going down. Golds are probably a safe haven, which means here at the end of February, beginning of March, it makes perfect sense. Stocks sort of fall off a cliff, as we know. Gold moves on to higher highs. This now fits that narrative of gold as a safe haven. The problem is that works until it doesn't. So if you look at the middle of March, gold actually sold off, and both stocks and gold were in a downtrend. If you look from early, sort of second week in March to where we're at now, gold and stocks have actually been relatively positively correlated. They've been moving in consequence. So they've been moving together. So when gold has rallied, stocks have rallied and vice versa. And they're now both sort of rotating to a swing high just in the last couple days. So the problem with the narrative is if you make that your investment process. X happens, so Y should happen, and that's how I'm going to make my bets. What I would encourage you to do is treat a narrative as a fuel for further analysis. The narrative of gold as a safe haven should cause you to dig into the charts. Look at the correlations. Look at the conditions as to when gold and stocks agree and when they disagree. And also think about all the other levers that could be affecting the value of gold and the price of stocks, right? What are interest rates doing? What are currencies doing? What are global markets doing? And obviously now we have a lot of macro drivers to equity prices and other assets as well. So narrative bias, I think by definition, is a bad thing, or a less constructive thing, because it's causing you to make decisions based on purely on a narrative. I think a narrative can be good if it helps you to lead to further questions. That does not provide the answer. So that's my description of what narrative bias is. Hopefully that helps you make sense of it. The second one I was reading in the CMT Smart Brief, we'll get back to that, of Janet Yellen's quote in the LA Times. She says that economic growth is likely to remain low for years, not months. And there's a link to an LA Times article. So the CMT Smart Brief is something that goes out to the CMT Association members. If you go to their website, you can find out more about them and what they do. And I get that newsletter as well. It's a great way of identifying technical analysts around the industry and where they're being quoted and what sort of things they're doing, which is really helpful. It also has some non-technical content. In particular, this article is talking about recessionary pressures and the potential for slower economic growth. So again, you're going to get the answer here of a technical analyst. So keep that in mind. So I am not an economist, but I will tell you what I'm seeing on the charts. I would say, remember with anything like that, when you're talking about economic growth and whether it's going to remain low or remain strong, couple things I would say. Number one, remember, if you look at a basket of leading indicators for the economy, do you know what one of the number one leading indicators for the economy is? It's the stock market. So a lot of people look at the economy and use that as a way to try to make sense of what's happening in stocks, what's going to happen in stocks, when actually it's the reverse. You should be looking at the stock market to get a sense of what the economy will be doing in the future, because the stock market's actually a great leading indicator for the economy going forward. It's one of the best ways to identify future direction of economic trends. So I would not worry too much about economic growth slowing and having that be a problem for stocks. I would be looking for stocks and what prices are doing, because that tells you where people's expectations are. And again, when people get nervous about the direction of the economy and the ability of companies to grow earnings and all of those sorts of things, that's what causes the price to go down. That's what makes it a great leading indicator, because companies digest all of that over time. Months and years down the road, we'll be able to look back in the rearview mirror and define when the recessions were. And so I guess that's the second point. Remember, recessions usually are very clear in the rearview mirror. As they're happening, you will hear economists debating whether or not we're actually in a recession. So again, my number one thing is look at price. My number two thing is, remember, stocks are actually a leading indicator for the economy and not vice versa. The final question, and boy, we're actually going to time this fairly well, I think. On the 3 and 3 last week, you mentioned the dead cat bounce. Is there a certain magnitude that price has to move in order to call it a dead cat bounce? Or is it just a bounce off major oversold conditions with a return to the downside? That's a really, really good question. And the short answer is no. That is very much a trading sort of vernacular. And there are a lot of phrases like that people throw around. And there are more ways to visually sort of personify what you're seeing in the market. And so, I would say, it is a very subjective call. And I think the quote unquote dead cat bounce is anytime you have a severe down move and then a sudden upturn. And so most bear market rallies, as the long-term trend is down and you have a short-term uptrend, that's what you would call them. And again, visually it's horrible, but you think about it's what basically charting the path of a cat as it falls down. It's sort of what it is, bouncing. And the idea is, yes, the expectation is that means a short-term rally within a longer-term downtrend. I would also, and I guess maybe as a second way and a way of extending the answer to that question is, I had some questions about what defines a bear market. Is it 20%, 30%, and all that? I would remind everyone, those labels of we hit 20%, okay, we can formally label that a bear market. For me, that's more of a financial media type of thing. I don't know if the market being down 19% and then being down 21% means it's dramatically different. I would say there are signals way before that point that tell you whether or not we're in a bull phase or a bear phase. So for me, it's more about the highs and the lows and how they move, and less about a particular guidepost that tells you percentage-wise when we're in a bull or bear phase. Those are 3 really good questions coming from you in the last week. Thank you so much. Please keep them coming, and we'll answer them in a future segment. We're going to take a quick commercial break. Back with my guest, Harry Boxer. We'll see you in a minute. Hey everyone, welcome back to the show. I'm your host, Dave Keller here at StockCharts.com. As a reminder, please keep your questions and especially your feedback coming to us, the final bar at StockCharts.com. Also, you can see all of our previous episodes on our YouTube channel. Check them out. And if you have questions, shoot them our way. Now, we have a lot of great experts that we bring in to the Stock Charts fold to help us answer these questions about what's happening and how to make sense of them. Today, we have a great guest, and I love talking to traders that think from a more of a short-term perspective. I'm more of a long-term guy, so being able to relate the two are really, really helpful. And I want to welcome on my guest, Harry Boxer. Harry, thanks for coming on the show today.
My pleasure. Thanks for inviting me.
So you asked us to bring up a couple charts. We're starting with an hourly chart of the S&P. How do you make sense of what's happening in the last couple of weeks? And then obviously today with a bit of distribution here.
Well, when you look at the overall drops, but let's start with the S&P 500. And you dropped 1,200 points on from 34 to 22, basically. And you're down about 35, 38%. There's no question that's a bear phase. Now, is it exacerbated because of computerized trading programs? I believe so. I think that this is the most unusual bear drop that I've ever seen. I've been doing this over 50 years. I can tell you that usually a bear market decline of this sort will take 6 to 8 weeks, 3 to 4 months, something like that, and it'll come down in 5 waves, basic LA wave stuff, where it drops. If you look at the S&P coming off the high, you don't have it right here, but if you look at the S&P coming off the high, it basically came down, rallied for 3 days. This is the hourly chart, but that's the only 3-day bounce we had. After that, it was vertically, it basically imploded from 3150 to 2193. And there was no 2-day rally. Seriously, I looked at them carefully. There's 4 times they rallied for 1 day, and the next day was down again. A very unusual selling and extremely strong selling. And is this the big question is, I tell all my subscribers, is this the first thrust to the downside that breaks the major trend and sets off a 5-wave decline, which could last several weeks, even several years, at least several months? What we have so far, and what you've seen so far, is a climax low. And at that point, I told all my subscribers to back up the truck. And the reason I said that was we had a McClellan oscillator was minus over 400. I was told by Tom McClellan, excuse me. And so I knew at that point that the oscillator was so oversold, so the market was so stretched to the downside that we had to get a snapback, and probably imminently. Also, the tick numbers were minus 1,500, 1,600, 1,500, 1475. We had 3 readings of plus 1475 or more. And the level of intensity on the downside was pervasive. And also the amount of people I talked to, they're institutional, were talking bear markets. I knew that at that point, when people were throwing in a towel and selling stocks at the lows, that we were going to get an imminent turn. And what really was interesting on the 23rd, 24th, right around that gap you'll see right there, right? That was the what I would call the breakaway gap. And then even though I don't have trend lines drawn in here, you can see if a declining tops line that was broken right at the same point, right exactly there. And so then we had a little bit of a retracement for 2 hours, basically, intraday, right there. And then the market took off. We consolidated for a few days, and then a few hours, and then came down and retested the 2450 level twice. Now, the gap up we had on yesterday morning it signaled to me that we could take out the double top from March 27th, March 31st. That happened late yesterday. And again, this morning, we popped up to 2750. Now, what's interesting about 2750, if you take a look at the low under 2200 to 2750, it's about 560 points roughly. And if you look at how many points that is versus how many points we dropped, which is about 1190, that was something like close to a 50% Fibonacci retracement. So this morning, when the market was up near my resistance level and up near the channel top that I've drawn in, I felt like we could get a pullback, but I was a bit surprised how dramatic and how quickly it dropped off. But I shouldn't be in this market because, as I said,
I think we've lost the right to be surprised by anything at this point.
I'm not surprised by anything. That is correct.
Now, you also wanted to look at the Nasdaq, and obviously the question on a lot of people's minds is with technology, right? I mean, the technology has been such great leadership. That's where the strength has been. Are you seeing anything different or anything that concerns you or excites you looking at the Nasdaq in particular?
Well, the patterns are exactly the same. We had a double bottom, by the way. We had a breakaway gap. We had a run up, pullback, and then the double bottom again in April 2nd, 3rd, in that area there, and then the breakaway gap. So now we pulled back in a three-wave little mini corrective. If you look at today's intraday, it's down, up, and back down for 3 waves. What I'm going to be interested in finding out is, can that high on March 31st around 8,000, can that hold tomorrow morning? Based on the close today, it may not. So secondary support is going to be down around the gap at around 77.50, and it wouldn't surprise me if it held it or bounced off of there, and then we'll see what the market's made of, or what the bulls have left, so to speak. I believe this is a 3-wave correction in an ongoing potential bear phase. However, I am much more bullish than most people I talk to. And the reason is I see so many individual patterns that have V-bottoms, a V-bottom with a right-handed extension that held 3 days in a row. If you look at the S&P 500 daily, you'll see that 3 days in a row it held 2450. And right there, 3 days in a row it held in that range. Then the next day it gapped up and exploded. But it got up to key resistance at a 50% fib retracement and then backed off today. I don't think the pullback's unusual. The question is, what will the market do now? Also, if you draw lines, and I have a different angle of ascent, but I was in discussions I had over the years with Tom DeMark, who I highly respect. He says, never draw a trend line off a spike low. Always draw it off the first pullback low. So, so what I did is I drew a line from the gap created the day it opened up, right about there, to that low at the triple bottom right there. And then you draw a line off your high 3 days prior, right? And then the high today. You got a perfect parallel channel. I was not surprised that it hit the top of that parallel channel. And now we should come down and test the bottom of that channel. Here's my supports. I want everyone to know what I'm looking at. 25.75. That means it's down 110 points from where we are now to test that level. And if it's successful, I think we go up to test the highs and then run up to 28.75, 28.90 range. That's where the market should have more problems, because then you have a 5-wave basic Elliott wave recovery, and then we're going to find out what this market's made of. Also, on my charts, I use a 50-period moving average. I'm a big believer, and I've talked to a lot of technical analysts, that the 200-day moving average is not useful for anybody who's a short-term trader. The 50-day moving average is used by every hedge fund, every institutional or mutual fund trader or analyst that I know of. So the 50-day moving average to me is way more important than 200-day. Right now on the S&P 500, the 50-day comes in around 29.12, 21.15, I think it is. So what I'm looking for, the potential is a pullback here, which we're getting, a reversal, and then a 5th wave up to about 2,900, give or take 15 points. Then we're going to find out if this market's coming down for a big 3rd wave down. In other words, if this is 5 waves within a wave 2, with the first wave being the big drop of 30-40%, the second wave back up to 50% to a 0.618 Fibonacci, which could get you up to 28.75. If you get a 5-wave advance up to that Fibonacci retracement, and then it rolls over, then you can get a nasty 3rd wave down to take the market down to retest the lows or make lower lows. I can't tell yet, but I can tell you that the reversal here was magnificent. And by the way, look at the low, that day the market hit a low. I want to point something out to you. Right there, that bar is almost, or I would say it's as close as you can get to an island reversal, because the market did gap slightly down the day before and then opened with a gap up the next day. So, and on some indices, it left perfect island reversals, which are very powerful. So one of the reasons why I thought we were going to get a really good, at least 3-wave extension here and upwards of a 50% retracement was simply that the market got to an intense level. It was oversold, extremely so on the McClellan oscillator. The tick was extreme, and we had an island reversal, all of which led me to believe that we're going to get a nice rally, and we did. And so my thoughts are basically that the next day or two are going to be telltale, because if this market takes 24.50 out, we're going to retest the lows and go lower. If it holds 24.50, in my opinion, and I'd love it to hold 25.75, because those are my 2 support levels right now.
Harry, that's such a great short-term take, and we have to cut you off to wrap the show. But thank you so much for joining us, and thanks for walking us through some of the short-term dynamics. There's a lot of key levels people need to pay attention to. Stay safe, and thanks again for coming on, Harry.
Appreciate it. Talk to you soon. Bye-bye.
Hey everyone, that was Harry Boxer giving us a great short-term read on the markets. We don't have time for the 3 and 3, but I tell you what, check out my Twitter handle at DKellerCMT. You'll see them all tomorrow morning. I'll make sure I send them out for all of you. For StockCharts.com in Redmond, Washington, I'm Dave Keller saying be safe. Thanks for watching. We'll see you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.